It's the 21st century. You ever heard of a little thing called AI?
If you're investing,
investors will.
The podcast for all things real estate investing.
So Scott, it's amazing having you on today on Investor One-on-One. I feel like most real estate investors today are chasing houses, but you're focused on something very different. Can you just tell us a little bit more about yourself and what you actually do in simple terms for our investors?
Yeah, sure can, man. And first of all, honored to be here. It's always glad to deliver and for your audience, stuff like that, honored and vice versa. But yeah, I'm known across the country as the note guy, basically. And I focus on a niche of real estate, specifically distressed real estate that a lot of folks don't know about. And that's the distressed mortgage side of the business. I buy notes, basically. I buy mortgage debt, primarily non-performing stuff from banks and hedge funds and a whole variety of other lenders, where when we buy that mortgage debt, we become the bank or the lender, and we have the same rights. And a lot of folks are like, oh, you're buying that and then foreclosing. We actually prefer to buy that debt at a discount because they haven't paid, the borrowers haven't paid in 6 months to 6 years. And our goal is to rehab the borrower, and we're successful about that 70% of the time. But I'm like many real estate investors. I've been, an active real estate investor for over 20 years, done fix and flips and wholesaling, been a landlord, raised a lot of capital. But when everything hit the fan back in 2008, I was a mortgage broker with a buddy of mine doing some real estate. And then the mortgage business basically stopped like that. So I went 100% full-time into buying this distressed mortgage debt that I had originated a few months earlier from banks. Fast forward now, it's hard to believe we bought over $1 billion, almost $2 billion in distressed debt on residential and commercial properties, raised millions of dollars, and it's just been a fun time because when we buy the debt, I like to say it's the sexy side of real estate. We're not dealing with toilet sinks and trash outs. We're trying to keep the borrower in their house, and we're able to do that about 70% of the time for great cash flow and great returns. Of course, that's not always the case. Sometimes you just got to foreclose because folks just can't afford it or can't have that come to Jesus meeting, and we go from there.
And do you guys operate just in Texas or nationwide?
Great question. No, I'm actually buying about 20 to 30 states. Texas is great. Most of our state, fastest foreclosure to fastest state to foreclose in, most lender-friendly state. But when I was a traditional investor back in the day before this, Austin, where I live, keep it weird. I'm on the keep it normal side of town. Austin's a very competitive market, and so I started branching out and buying stuff in San Antonio and Dallas and Houston, stuff like that. But when I really dived into the note business, I had these banks, and still to this day have lenders that send me lists all across the country. And it might be anywhere from like an individual note, say in Houston, or it might be 4,000 non-performing notes all across the United States, 950 states that I can cherry pick from. So we're actively looking at stuff in about 20 to 30 different states in the major markets inside of those.
For investors watching this, is there a state that you see becoming a little bit more trendy, a better place to invest in?
Well, yes and no. Texas has always been exciting because it's hot here with good values, not just the weather. But it's also, when you are buying in a state that has such a fast foreclosure time frame like Texas or Georgia, those states get a lot of buzz because it's faster foreclosure. People want to take the real estate back a lot of times. But it also comes with a little higher price tag because it is fast foreclosure. So we see people who are, like, say, living in California looking to buy debt or invest debt in faster states like Missouri, which is 90 days to foreclose, or Michigan, which the values are lower than what you could buy. I mean, we could buy for 50 grand, you can buy a pretty decent property outside of Detroit. Whereas in California, that's not even buying a doghouse these days. Yeah. So you see a lot of people that understand cash flow. They don't necessarily want to own the real estate, that it pays more to be the bank. And so you see people investing outside of their home state in states like Ohio, which has always been pretty popular, even though it's about a 9-month foreclosure process because there's just a lot of growth going on there. Indiana, the Hoosier state, has always been big for landlords, but note investors like it too because great values compared to other places across the country. Florida, your home state, as I call it, God's waiting room, has been popular over the years, but it's kind of lost its luster with the increased cost when it comes to insurance, taxes, and then the delay in the market, especially with what's going on in the condo market. I mean, back in the day in 2010, where I was walking down A1A basically, and I was buying condos back in the day, buying the debt on a condo for like $5 to $10 grand. It would take me a year to 2 years to foreclose, but then we would sell it at the auction. It was a very interesting time back in the day. It was literally like a page out of the movie The Big Short in a lot of cases.
Uh-huh. So Scott, like I told you, you're the first person that I have on that deals with note investing. We deal with a lot of flippers, wholesalers, and all kinds of investors. What's something about note investing that would surprise the average investor on our end?
Really great question, Nora. I'm going to say a couple things. One, first and foremost, you don't need millions of dollars to go buy notes. A lot of people over the years have said, oh, you need to have $5-10 million for banks to deal with. And that's not the case. We're actually submitting bids on a tape from a major lender. They sent us a list of 47 with balances low down to like $8,000, $9,000, and somebody's bidding an offer at $5,000. So if you've got money sitting in an IRA, this is actually a really great opportunity for you because you can buy something with a small balance. It's going to be a good double-digit cash flow. These are some performing notes and non-performing notes. The second thing is, when you buy a note, you don't automatically end up with a property. And that's one of the hardest things for a lot of wholesalers, landlords, flippers. They want the real estate. When I buy a note, I'm the bank. So I have the same rights the bank does. And it actually, surprisingly enough, most times, if it's an occupied asset, it makes more sense for us to keep the borrower in the property, to get them back on track, making payments and cash flow so that our spread is a double-digit return. I mean, our ROI is double-digit, but the cash flow spread is higher than what most landlords and renters are seeing going through all that property management side. Another thing, this is great for wholesalers. Wholesalers, you can actually flip notes like you flip property in a wholesale deal.
And for those that, are just learning about all this, how do you acquire these notes?
Great question. When you want to acquire a note, you're not going out and you're not walking to the bank and say, hey, I want to buy your notes.
Exactly.
They'll throw you out like, oh, no, we don't sell our notes. I mean, ex-banker for Chase and Citibank back in the day, I didn't know that those banks sold notes. Now, those bigger banks like Chase, Citi, Wells Fargo, Bank of America, they're not going to sell you a pool unless you can write a $50 to $100 million check, and it's still not going to make sense. But there are still so many other smaller regional banks, lending institutions, mortgage bankers out there that have non-bank lenders that have stuff available to purchase. So we leverage LinkedIn a lot of time to contact banks and employees at banks who have specific job titles, like the title of special asset manager or secondary marketing manager or whole loan trader or chief credit risk officer, even a loan portfolio manager too. So you can buy notes from banks, different lending institutions if you know who to talk to. Now, a lot of these individuals work remotely or they don't work in the same building, or if they do, they're working at the main corporate office of these institutions. Part of what we've done over the last 18 years is contacting these asset managers and dialing for dollars and calling them and say, hey, what do you have on your books? Who's the right person I need to talk to? And then once you get on that list, the banks are going to send you stuff on a pretty regular basis, once a month, once a quarter. They're not asking for proof of funds, which a lot of people would think is differently. They're basically like, hey, what can you fund? If you can pass the smell test and you talk like a note seller, you look like a note seller, guess you're a note seller. And you don't want to tell them you're brokering the note for those wholesalers out there. You always want to say you're buying for your own portfolio. But as long as a bank gets a wire and payment, they really don't care for the most part.
Oh, that's awesome. And you spoke a little bit about LinkedIn, and we spoke about this before. How important is social media for especially real estate investors? You've built quite an impressive audience of around 30,000 followers on LinkedIn, which is insane. How did you get to those levels, and what are you sharing with your audience these days?
Well, so what year is it? Or I want to make sure everybody understands what year it is, because it's 2026, not 1986, right?
Exactly.
Fortunately, this is not to piss anybody off, but I don't give a rat's ass, okay? There's a lot of educators out there that have been around for years, and that's great, but they're doing business like it's the dark ages, like it's the 20th century. It's the 21st century. You ever heard a little thing called AI? It's not, look, we don't send out direct mail campaigns, except to raise private capital, because most of our stuff is coming. Not that that doesn't work, because that works well, but you got to go where people are at. Social media is relatively free, easy to use. You got to market your business because AI, artificial intelligence, is looking at what people are posting. If you're not posting, it can't recommend you to people looking. Who's the best wholesaler in Miami? Who's the best fix and flipper in Indianapolis? Whatever your niche is, you got to tell people what you want to be, because being a secret agent is all that's going to achieve is you end up being broke. All right. We sell a lot of deals. We've moved a lot of assets. We've raised a lot of capital leveraging our social media by posting on a regular basis. And if you're going to be a real estate longer than 6 months, which most of you are, I don't think real estate investors ever retire. We just die. Is that if you start marketing now, guess what? That stuff will build over time. If you're here for the long run, I mean, let's look at McDonald's. When was the last sporting event you watched on TV you didn't see a McDonald's commercial? I mean, they've sold billions and billions of hamburgers, but they still market like crazy, right? So you just thinking about me saying that name has now got that golden arch in your mind, the fries. the taste of the crappy Big Mac. I mean, I make a much better burger than Big Mac, but guess what? They market on a regular basis, and you can do the same thing, use the same tools. I mean, with LinkedIn, it's changed. They used to allow you to send out like 100 connection requests a day back in the day when you had a cat. Now it's like 20 to 100 in a week. Still more people. That's still better to do that in network because most of you aren't going out and talking to people. You're hiding behind your laptop. We use a service, have used it, can't really use it much anymore because LinkedIn likes to cap you at about 30,000, but we use a service called Octopus CRM. And for like $22 a month, I would log in every day, would make like a list of 1,000 contacts, profiles, and I would send out, 50 to 100 connection requests to asset managers, real estate investors, even podcast hosts back in the day of just reaching out and connecting. Hey, I saw that you're an investor in Georgia. What are you buying? Or, hey, I saw that you're an asset manager at your bank. What do you have on your books this quarter? Really helped automate that. But so we went from 6,000 to 30,000 using that one tool over a few years. So that's a long-winded answer to a short question you asked me.
I love it. And I could see the passion. I could see that, you're ahead of the game when it comes to this stuff and you're getting the results that you want. Following up on that, you spoke a little bit about AI. What systems or tools, you just named one of the tools, are helping you and your company scale?
Man, there's so many different cool tools. Like we use Claude, we use Gemini, I get up in the morning and walk in the mornings and I'm listening I call her Gigi, which is X's Gronk. And so my Gronk helps me with the topics or with news articles that I can talk about in my podcast, or I can help share news that's going on in the market that's relevant to my clients. And that's the thing, is it helps me create emails, help me come up with topics when I have a brain fart, can't think of anything. Of course, Canva is a great AI tool as well to help you create images. I take our podcasts and then we'll write them 2 or 3 different ways depending on the article and what we're using it for. And so AI goes out there and looks for you to be sharing things. And if you're just taking one article and reposting it, it really only recognizes it as one. But if I'm rewriting and tweaking it up 3 times, it's like, oh, there's 3 different articles, which boosts my AI. I mean, we've got a ton of videos, ton of podcasts, stuff like that, but I cloned myself about 6 months ago using Delphi, where there's now a 365-day-a-week clone that can answer questions via phone or text message to my clients. So it helps answer a lot of questions, gives them the answers to all their burning questions at 2 o'clock or 3 o'clock in the morning when they can't go to sleep without me having to answer all the remedial questions. So those are some of the tools. Of course, there's great, when we get loan documents in or loss mitigation stuff, we'll upload those files into Gemini and others, and they'll come back and help us scrub it and help us identify issues. We're working on a couple different AI tools when we get these lists in to help us identify the best deals based on our parameters and what we're looking for as well right now.
I love that, man. I feel like I brought you from the future, like you saying all this stuff. Our investors are going to love this.
But that's the thing, is you have to adapt. I mean, that's one of the big things I've always prided myself. And you agree with me on this, most real estate people or most people that work a 9 to 5, they put their marketing and their business as the last thing they focus on, right? So you get home from a bad day, you're pissed off, you want to kick your dog or your cat. You're angry because your boss chewed your ass out. You hate your job. You're just not happy. And so you don't feel like going out. I've always taken the approach from some of my mentors early on to take a marketing first approach. Let's spend the first hour of the day marketing our business so that's getting out and generating. You feel like you accomplished something, and then you're off rock and rolling. Another thing is you've got to have mentors. You got to have people you listen to on a regular basis. I've had some amazing mentors over the years who would help me identify opportunities. Like I said, I'm coachable. Teach me something new, coach, and I'm going to dive in there. You can't sit on your laurels like, that's how we used to do business and we liked it. Well, if that's how you did business, you're going to be out of business, and you got to tweak these days.
Now, since we brought you from the future, what are your thoughts about where the market is heading to in the single family space, at least?
You don't want my outlook. Realtors will be removed, replaced with AI. We've already seen that. About 6 months ago, there's a company in Spain sold over $60 million in real estate, all with AI, without a single realtor. And then they took it down because they were scared. All right. You're going to see more and more of that with the way technology works. The same thing. I hate to say this with mortgage brokers, mortgage banking. You've always had, for the last 10 years, you've had automatic qualifying. If you filled out a loan application, it would often spit out, oh, you're automatically approved. We call that automatic underwriting. That was basically AI. If you hit this, this, and this, you qualified for this. And I think that's going to be the case. is you're going to see AI basically hold your hand, book a phone call, you go see the property. There's going to be a video there of somebody talking about the property, doing a virtual walkthrough, and then you're just basically filling out your information and, okay, you're approved for the loan. Let's get you closed. So I think loan officers, realtors have to be very apparent about that. You have to market differently than you've done before, because I think there's going to be a lot of those platforms that come in and say, hey, we'll help you list. I mean, with the NAR lawsuit that took place last year, it really hurt a lot of buying agents, with the whole commission thing. So I think you're going to see more companies come in and say, hey, we'll help you buy and sell your house all with AI, so you don't have to worry about anything. Another thing that's going to be affected too is just if you're real estate investors, I think you've got to be speed. The whole thing to speed. You've got to be able to make a decision. You got to understand what your market is, and you really got to leverage your tools through either online valuation. I'll give you a great example, or a roofing company that we use here. They rarely send somebody else out to give a bid these days. It's all done online via AI and Google Maps, and even sending out drones to take photos where they don't have to go out. So they're saving, tons of money without the actual physical person going out. It's all via drone and via online. And then when they really do sell, then they send somebody else out for final. But they're pretty close on their values. Same thing on rehabbing properties. You got to use if you're not going to stage the property, you got to use AI staging tools to give people help them see what the bigger picture is. So it's just a lot of change. I don't think anybody's going to replace the plumbers, the electricians. You're still going to have those folks that have to come out and actually implement it. But if you're in some sort of service and you're not leveraging AI, you're going to be in a rough thing. Look at this. New York City, right? Most expensive real estate out there. Restaurants, fast food restaurants are using Zoom and using AI people to take orders, or they're paying Filipino VAs at $4 an hour on Zoom to take your order to submit it in. You got to rethink how you're doing things these days, everybody.
I love that. Now let's go back a little bit to the notes and talk a little bit more deep dive into numbers. Can you walk through me kind of from A to Z, a real deal that you've done from the moment that you brought the note to how much or how you made money on it?
Yeah, I can talk with a small one, but why don't we talk one about down in your neck of the woods? Like, where Cutler Bay, Florida is,
Is it on the west side?
It's on the west. It's on the east side. Cutler Bay is just north of Miami. Actually, it's in Miami-Dade County. It's a really nice, ritzy area of Miami. Average house is, low end's over $1 million for the most part. So, I mean, we get stuff in all the time. We got this one note in. Borrower owed $1.2 million on $1 million house. It was it was valued about $950. Borrower hadn't paid in 4 years. Okay, but they drug it out. So we ended up buying that note because we knew it was going to take a lot of foreclose for $441. COVID kicked in, so it delayed the foreclosure another year. But we eventually foreclosed on the asset, on the guy, evicted him, and then we turned around and put about $50,000 into the property and listed it for 1.25. We got an offer at 1.1 and approved it. Obviously, legal costs, repair costs, stuff like that dragged down a little bit, but we still made over $250,000 on that deal on a foreclosure. I like those kind of deals down in Miami, but same thing, like we're looking at another deal right now here in Austin, Texas, where the borrower is behind by about 6 months. They owe $250 on the deal. Their mortgage rate is 6%. They're upside down. They actually owe more than their property's worth. We're going to pick that note up for about 50 cents on the dollar. Now, if I can get that borrower back to start paying on time again, the 6% mortgage they have, if they start paying on time, that's a 12% cash and cash return to me. If they bring what they're behind on, it puts that at about a 13 to 15% cash and cash return. Now, if they don't play ball with me, we'll foreclose and list it at the auction for about 90 cents to the dollar. If it doesn't sell, we're picking up for about 125. We'll list it for sale at 250, sell it for 225. It'll probably take about 6 months to do that start to finish and be sitting pretty good. Like I said, we like to try to rehab the borrower if we can, if they're worthy of it, for a double-digit return. If it doesn't work out that way, then we take the route to go to foreclosure. And or either cash for keys. We have another borrower here in Texas that we actually gave the borrower $75,000 cash for keys to avoid it going to foreclosure, to have them walk away because there was so much equity above what was owed. So, like I said, those are some bigger numbers. I've got one. I like to share this story. Borrower hadn't made a payment in 4 years, been trying to do a loan mod for about 5. Only owed $60,000 on this little crappy house in Southern Illinois. House is only worth about $35,000. They owed $60,000. They were upside down. Lived in it for 18 years, raised their 3 daughters. Well, they've been trying to do a loan mod, like I said, trying to adjust things. Her husband had a heart attack. She was still working, but their income had dropped down. Well, we bought that note for $12,000. They owed 60. It was worth only 35. Their monthly P&I payment, why they couldn't afford this, I don't know, but it was $400 a month. Okay. So we contacted the bar, said, listen, I see that you've been trying to do a loan mod for 4 years. Can you start making your existing payment? I know you can't come to the table with 4 years of payments. And she's like, yeah, I can start making that $400 a month. I said, can you bring some skin in the game? She's like, what do you want? I said, well, I'd like $5,000. She's like, I can't pay $5,000. So can you bring 2,500? She's like, yeah, I can do 2,500. I'm like, great. Can you pay an additional $200 per month? She's like, I could do it. Now her interest rate is like 12%, or, I mean, this is ridiculous. Okay. I said, okay, Sheila. I said, you and William, this is what I need you to go meet with my attorney, bring a check for $2,500, start paying your $400 a month plus $200 a month extra. If you do that for a year, at the end of the year, we'll evaluate the property. We'll forgive any balance above what's owed. So if the value of the property goes to 45, we'll forgive 15 grand in value because it's not there on what you owe. So she started paying on time, and at the end of the year, we forgave her 10 grand on her house because it was up to 50, but we also dropped her interest rate to 0% so that she could pay the house off in 6 years versus 30 plus years. She paid on time for 6 years, paid that house all off. About a year into the deal of her paying on time, she called me up and was like so happy, wanted my mailing address, sent me a Christmas card, and it was her husband, and 3 kids, and their newest granddaughter that they named Carson after me for helping them stay in that house. I mean, it was a great deal for her. It was a great deal for me. I paid 12 grand. I made 10 grand the first year, and I made roughly, 4,800 for the next 6 years as well. So it was a phenomenal ROI, and it was a win-win scenario for that. Keep them in the house. I didn't want to own the property, but still made a great yield.
What a story, man. And a win-win, like you said. Love that. But, for the investors that are watching this, everything sounds amazing. The numbers sound good, but why are banks even willing to sell these notes at a
Great
discount?
question. I get that. Why would a bank sell you a note versus foreclosing on themselves? It all depends, because you got to realize every state's got a different foreclosure time frame, and banks buy and sell portfolios. Sometimes for every non-performing note a bank has on their books, they've got to hold that much money back in reserves that they can't lend out. So a lot of times, especially when notes are in like longer judicial foreclosure states, which take longer than 6 months, if a borrower stops paying, the value of that note to that bank goes down 5 or 10% per month. Okay, so if somebody hasn't paid in 6 months, the value is dropped. The paper isn't worth what it was written on. So they would rather sell that note off at 50, 60 cents on the dollar, collect that money, and then be able to go lend it out, get that problem borrower off their books, and then let me deal with the problem children of working with them, working out. Because I'm a much more lean, mean, note buying machine than they are. And so they would do. Now, in states where it's fast foreclosure, like Texas, Georgia, they may go ahead and foreclose because it's pretty quick to foreclose. But if a borrower is dragging things out, or it's a longer state, or maybe the bank bought a portfolio cheap back in the day. Now they just want to sell it off and make some money, so they'll hold it for a period of time. So, like I said, you're not going to buy it from Bank of America, Chase, Citi, Wells Fargo, but there's a lot of other lenders out there that either A, have had to take an asset back because they originated it and then sold it off to a bigger bank, but when the borrower stops paying, they got to buy that note back, and that clogs up their ability to lend more, so that they can sell it off. They can go rinse and repeat and leverage that money and make 10, 15 times what they owe, what the money came in on it is. And it's a win for me because I buy it at a discount as well too. So that's part of it. I mean, you're not going to go down the street here and say, hey, I see that vacant house over there. I want to buy the note on it, and call me up. I said, well, it all depends who the lender is. Some lenders don't, some lenders do. And there's plenty of opportunity out there. Like, here's something that most people don't know. There are 5,000 federally chartered banks across the country. And you can probably buy notes from about probably 60% of them at some point, residential or commercial. But there are also an additional like 20,000 non-chartered lending institutions, mortgage companies, private investors, stuff like that are originating notes. If you have a 3% default rate, or actually a 4% default rate across that, that's a lot of non-performing debt on books that people need to get rid of. Okay. So that's something to keep in mind. It's just, it's a crazy world. Like down in Florida right now, you saw a lot of stuff in Cape Coral, Fort Myers, Lehigh Acres, that were all like the DSCR loans. They're Airbnb loans. Well, when nobody's renting those houses, those mortgage payments aren't getting paid. At least an opportunity for you to step in and buy that stuff at a discount and then try to work it out in some sort of fashion.
And in your opinion, where are people making mistakes in this industry? Where do they go wrong or usually get burned? Very
great question. I just had a phone call with a realtor who bid on 2 assets, and the property was worth 201, but the borrower only owed 90. Well, he bid 130,000. I'm like, why did you bid 130,000 when they only own 9? He goes, well, that's a 60, that's my MAO. 70% of as is value. I'm like, well, but we don't deal with as is or ARV value. We're dealing with as is value. We're dealing with the note. The borrower only owes 90. Don't pay above what's owed. You would pay 70 cents on the dollar for that deal. So you should be paying 63, not 130, so that we see people come in that don't understand the difference of owning the note versus the property. So they overbid and they get upset about that, or they don't do their due diligence on the asset, looking at the borrower or the payment history. One of the easiest things that you can do is check taxes owed. Well, some people they buy a note don't know that they have to pay the taxes. If the borrower doesn't pay, they lose it to tax sales. It's a different type of due diligence. Not only are you looking at the property, making sure value's there and stuff like that, but you're also looking at the borrower. How creditworthy are they? And then, of course, you're also looking at something called the collateral file. This file right here is what you're looking for. Payment history, copy of the original note, mortgage, servicing history. This is really what we're looking at. This is what with this note, I paid $20,000 for an $80,000 note in Kankakee, Illinois. All right. And the borrower was supposed to pay $578 a month. Well, on a $20,000 investment, if they're paying, let's just say 500 times 12 is $6,000, $6,000 on a $20,000 investment, that's a pretty good return on investment if you ask me. You know what I mean? So that's the thing. It's a different thing owning the note versus the property. Would you like to end up with a property? Yes, sometimes it happens, but a lot of times you're going to reinstate that borrower or work to get them back on track and go from there.
Scott, you have so much experience in this industry. If I had to, take everything away from you and just leave you with your wisdom and give you another $10,000 in cash, how would you restart today, and by rebuilding in this?
Really simple. I would be buying leads. I would be using your guys' service to buy a lot of distressed leads out there and start targeting people. I would start networking, going to your local RIA clubs and networking with investors, finding out what people are buying, start talking to the wholesalers, start talking to landlords who are dealing with evictions, who are probably tired of owning rental property, and just start networking like a madman. You know what I mean? And then, most people don't do that. Most people don't realize that the art of deal is in the follow-up. 80% of sales comes after the fifth contact. So that means fifth contact. That doesn't mean you send out one postcard and you sit around and complain when nothing happens. That's a postcard. That's door knocking. That's a little social media sleuthing. If the borrowers are on social media, hey, I know you're losing your house. How can I help you avoid it? Or just rinse and repeat, following up. That's one thing that 90% of investors get wrong. They don't create follow-up systems or campaigns to follow up things on their leads. And that's where they lose most of the businesses, where they get frustrated. They drop a lot of money and don't follow up. And literally that first lead, that first marketing piece is just the tip of the bucket. So that's the thing I would say. Just be a follow-up animal. 70% of the deals that we actually close on comes a month or 2 months after we originally made offers that we followed up, because the bids that were higher than us, they fell through. People couldn't close. And now the seller or whether it's an institution or a private seller is motivated to move now at our lower price. And it comes out being a win-win for us then.
Great tips, man. And if I could steal a little bit more wisdom from you, what's a piece of advice you can share with our investors, or even a resource?
Oh my gosh. So this is simple. We can all agree that a lot of investors, they like the idea, but they stop taking action because they don't have their own retirement savings or their own private money, right?
Mm-hmm.
There's so much private money out there, literally trillions and trillions of dollars. Here's the thing. If you like self-directed IRAs, the average self-directed IRA investor has at least 180 grand in their account with Equity Bust or Inspira or Pensco. That's the average, okay? In most states, you can actually go to the county recorder's office or the county clerk or the county appraisal district, type in an IRA company. So I can go here to Williamson County, Travis County. I can even go to Miami-Dade and Fort Lauderdale, Broward County. I could go there, go to the appraisal district, type in Equity Trust. And it's going to pull up a list of people who have used their Equity Trust IRA account to buy a piece of property. Those people are real estate investors who've closed a deal. They're investors, so you don't have to educate them on everything. They've got money. With IRA money, it's got to be passive. They can't be active in it. So it's a great way to raise capital on a passive base, whether you're buying notes or fixing flips or whatever. Tapping into private investors is one of the most important things that keeps you going long term. How do you connect with them? Same thing. Hey, I saw that you bought a property. I'd love to talk with you. Or, hey, I see you online. Are you looking for more deals? I've got some opportunities. So that would be one big piece of advice I tell people: start marketing in your area, start reaching out to those IRA investors, and then you're a postcard letter campaign away. Everybody is 90 days away from raising $1 million if you just market to IRA investors.
Wow. Scott, you're amazing, man. And what's next for you, you would say, on your business, for your
Wait,
business
we talking
and on a
now in
personal level?
2026 or
We're talking
2030 where I'm from the
2026
future?
and 5 years from now, we know what's gonna happen. So
Oh
if
my
you could
gosh.
tell us,
You know what? 5 years from now, it's hard to say, because you never know what's going on. We live in such a chaotic market these days. But I tell you what, we are trying to buy as much distressed stuff as we see because we haven't seen this much distressed mortgage debt since 2008, 9, and 10. It's a little
wow,
bit more expensive than it was
yeah,
back then, but it's still at a huge discount compared to what it's been in the last few years and what traditional investors are. So just trying to buy as much as possible. We've leveraged AI multiple ways to help us be able to answer questions, be a resource for people, and just literally just trying to educate as many people out there. When we see a spike up in search and people visit our websites, we know people are looking for stuff. So just trying to be able to deliver great content with our podcast and information, and also just great deal flow to people at discounts that they're not seeing in other places. That's the biggest thing.
awesome. And on a personal level, just to get to know you a bit more, what's next for you?
Next for me, man. Well, I don't have any kids. Me and my better half, we got some four-legged furries that are friends. We love Austin, Texas, but we're probably going to be moving somewhere a little less chaotic, looking for some land, probably down closer to the coast. I grew up down in South Texas, so close to my mom and family down there. Just relaxing. We're trying to buy as many notes that we can get cash flowing so that we don't have to work so hard. So in 4 or 5 years, we've got a couple hundred notes, paying us a great yield, and we can do where the hell we want. You know what I mean? That's what true freedom is. Doesn't matter if it's 10 grand or 20 grand or $3,500. If you can create cash flow that covers what you need every month, then you've got freedom. And so that's what just trying to help as many people. I would love to educate another 1,000 note investors to go buy their first note in the next 24 to 36 months, but mostly just having fun, enjoying life, man. I work from home, don't have to travel as much. When I do travel, I especially like going to Florida there, but also like Fort Lauderdale. If you ever get a chance to go to Coconuts, it's a great oyster bar, greatest cock fritters in the world there, right by downtown Fort Lauderdale there, bud.
So next time you're in Fort Lauderdale, let me know. I'll come with you for sure.
We'll do, man. We'll get a good mojito, or go down to
Mojito.
Havana 1957 and have some coconut mojitos down there, brother.
Awesome. I would love that. Scott, thank you again for joining us today. I learned so much about note investing, and I feel like our investors did too. If they want to learn more and connect with you, what's the best way to do that?
Really easy. You go to our website, weclosenotes.com. That's weclosenotes.com. That's our website. You'll see the podcast. You'll see all the different classes that we teach, and then be able to book a phone call to talk about if you're looking to buy. Of course, you can always book a phone call with me directly at talkwithscottcarson.com. That's talkwithscottcarson.com, and let's go from there.
And of course, also on social media for sure.
Yeah, I'm one Scott Carson, as most of my thing. I am the only person the only Scott Carson more famous than me is an English soccer player who was a goalie for Manchester City. So if you tag Scott Carson, you're going to get me, or you're going to get the soccer player with a big gap in his front teeth.
Awesome, man. And then for all the investors watching this, if this conversation gave you value, make sure to like, subscribe, and share with someone who needs to hear this today. And we'll see you on the next episode. Thank you so much, Scott.
Hey, thank you for having me. You guys go leave that 5-star review. We as podcasters love to see that, know that you're listening.